Next up is session 3, Risks and Opportunities, the Cost of the Deteriorating Financial Relationship with the US and China. After this session, we'll have a lunch break, and then we'll have our semiconductor panel, so stay tuned for that. For this session now, moderating is our advisory board member, Andy Rothman from Matthews Asia. Speakers include Nick Borst, Nick Lardy, Rui Ma, and Edith Yeung. Andy.
Thanks, Margaret. Welcome, everybody. We've got a great panel to talk about this, and we're going to also have a great time following up on that interesting conversation that we just finished. And our panelists come at the question of the cost of deteriorating financial relationship between the US and China from very different perspectives. So I'm looking forward to this. We're going to start with Nick Lardy. Nick is a senior fellow at the Peterson Institute for International Economics. He's been writing about the Chinese economy for 50 years, and I have learned a tremendous amount from Nick dating back to the 80s, I guess, when I started working in China. And so I'm really excited to have him join. Nick, please share your thoughts with us on the good, the bad, the ugly of the deteriorating financial relationship.
Well, thank you, Andy. And I want to thank the Asia Society of Northern California for inviting me to participate in this panel. Why is the relationship deteriorating on the financial front? Well, I think it starts with the fact that Washington fundamentally misunderstands China, and I would say particularly members of Congress. Many of them seem to believe that China's growth has been possible only because of access to US capital markets, and thus cutting off this access will derail China's economic growth. The reality is far different. China has not depended, at least from a macro point of view, on external finance. Their growth has been entirely self-financed. Now, some individual firms at one time or another benefited from listing on New York markets, but that is no longer necessary. Hong Kong and to some extent the Shanghai market now support the large and liquid IPOs that many companies are looking for, and they found in New York in the past. Just for example, in 2020, China's markets had a record number of IPOs. They raised about 65 billion in IPOs, another 120 billion in secondary offerings. And these included some very large listings like the $9 billion listing on the Shanghai market quite recently of China Mobile, which was booted off the New York Stock Exchange last year. Smaller firms that once might have listed on NASDAQ are served by the Science and Technology Innovation Board of the Shanghai Stock Exchange, and more recently and increasingly, I think, by the newly established Beijing Stock Exchange. So that's the first problem. There's a fundamental misunderstanding of China's growth and its sources that has led to policies that I think are not going to achieve what those people want. Secondly, there's a widespread misperception that China's domestic financial markets are pretty close to foreign participation. But as we've seen in the last couple of years, and I'm sure other speakers will touch on this, a number of US securities firms, asset managers, insurance companies, and so forth have been able to establish wholly foreign-owned companies in China or have been able to assume control of joint ventures in which they were previously minority partners. And their domestic markets continue to open beyond the institutional arrangements I just mentioned. For example, last year, foreign ownership of Chinese government securities, the sovereign issues of China, increased by 30% to about 2.5 trillion RMB. That means in China, foreign investors own a little bit more than 10% of all of China's sovereign bonds. That's roughly 5 times the share that foreigners own of sovereign bonds in India. So the market's pretty open in certain respects. And finally, I want to talk about foreign direct investment inflows. These have been particularly strong, 212 billion last year, up 10%, while global flows declined by about a third or almost 2/5. So China's share of global inflows last year doubled to 25%. And this year, they're doing even better in the first 3 quarters of 2021. Inflows of foreign direct investment into China reached $250 billion US dollars, which is almost exactly twice the pace of the first 3 quarters of 2020. So that's just another indicator of the extent to which China is deeply integrated. So in conclusion, I would say cutting China off from US markets appears to impose little or no costs on China. On the other hand, cutting China off from US markets does impose some costs on U.S. financial and legal firms as well as on U.S. investors. So net, it's a losing proposition for the United States.
Thanks, Nick. A great way to start. And before we turn to Edith, just a quick question for you. Why do you think the Chinese government continues to open its financial markets to foreigners, especially given the rather toxic political environment between Beijing and Washington right now? What are they hoping to gain from that?
Well, I think the main problem of Chinese economy, is not the slowing growth of the labor market and some other things people talk about, but it's the continued misallocation of capital domestically. And I think they believe, perhaps correctly, perhaps incorrectly, that's hard for me to judge, but I think they certainly believe that having more foreign participation will improve the allocation of capital and make it more likely that they will sustain satisfactory levels of economic growth.
Great, thanks. So now I'd like to turn to our second panelist, Edith Yeung. Edith was born and raised in Hong Kong and came to the US when she was 16 years old. She's the founding partner at Race Capital, which focuses on early stage investments. And she told me a couple of days ago, her family is all in Hong Kong, Beijing, and Guangzhou, and she's looking forward to getting back there when the long quarantine restrictions are lifted. So maybe, Edith, you can start off by telling us when you think that's going to happen, because I think everybody on this panel wants to get back to China and Hong Kong.
I was really hoping that it will at least get to 7 days, so I would just go back, and now it's 3 weeks. And in fact, just a little bit of story anecdote. Last week, a few friends of mine in Hong Kong and a couple government official was in a party, and one person got COVID. 100 of them all got to penny bathe, and 4 out of the 100 actually had to stay there for 2 weeks. And the 80 of them stayed there for 24 hours. It's something that I definitely don't want to be there. So unless they lift the requirement to stay in penny bays, I don't think I will be going back anytime soon. So on that note, back to topic, I think as a venture capitalist, like the way that I see this, and in many different angles, some is a little bit more personal, some is more from an industry point of view. And I very much agree with Nick and many of his point earlier. I think, I'm just very sad in some sense that there's so much political turmoil between China and US. I think coming from sitting in San Francisco now, there's just so much going on in China, and media often paint a picture that just things they don't, if US don't accept, Chinese company to go IPO or whatnot, it's going to be gloom and doom, but that is not the case. But from an early stage point of view, I like to kind of see things in two different frameworks. One is a Chinese company come to the US for various different reasons. And then the other way around, US company go to China. And being in early stage, I think in 2017, 2018, I see so many Chinese early stage investors, including the Alibaba, Tencent, Baidu, had all set up shop in San Francisco before. And now all of them either not very active or have shut down their offices. So Chinese investment into US companies is getting harder and harder. And there's a certain threshold, but definitely some of them well-known ones are not really here anymore. And then second is thinking about M&A. Since US government, the CVS blocked Alibaba or Ant Group buying MoneyGram, you just don't really see as much of activities, especially in M&A. In the past, Tencent acquiring Epic Games or the intention of Ant wanting to buy MoneyGram, those should be a very, very natural steps. But unfortunately, I don't think that is happening. And then, of course, not let alone what's been going on with ByteDance. And, Ray have a lot of really great content on her podcast that talk about that. And then last but not least, on the IPO side of things, in exit, as a VC, we often think about exit is M&A, IPO, direct listing SPAC. There's like multiple ways of going through all this. Didi certainly did not set a good example for other Chinese companies to get listed in the US. Having said that, I do have two 500, I previously was at 500 startups. One, Dated Cook, the other one is Pernetics. One is more for cooking content, and the other one is more for biotech. Both of them are actually getting listed in the US via SPAC. So it is still happening, but it's just not for certain industry. So that's basically for Chinese to US activities. The other way around for US to China is super interesting. I have in 2018, I have a company, American, the company name is FTX. They're one of the largest crypto derivative exchange. Sam Bankman-Fried, he actually decided to move from the Bay Area to set up FTX in Hong Kong. So at the time, BitMax, which is the largest at the time, was already in Hong Kong. So in some sense, a few years ago, Hong Kong was really welcoming, at least on the fintech or crypto side of things. Now, hard to say, who knows, because I think a lot of the policy around crypto is basically changing literally weeks by weeks, month by month. But I think it's really interesting. Sometimes like there are Chinese cities actually attracting certain tech companies to go to that part of the world. And then very much so agree with Nick. We're talking about the PayPal, the BlackRock, HSBC now offering financial product in China. And if we think about it, I think last year or the last few years, GM sell almost 3 million cars in China. I don't remember the actual numbers like for the US, but that's so many cars. And also for Tesla, China is the number 2 market for Tesla as well. So in some sense, I think even what's going on, what we see in the media, there's a lot of activities, for US investors or US companies that is actually still going on in China, but it's not being reported as much.
Thanks, Edith. And a quick follow-up question for you before we move on to Nick Borst. When you talk to entrepreneurs in China, what do you feel is their sense of the attractiveness of the US market these days, of having US investors or doing business here or collaborating with scientists here? Is there less eagerness to do that now than there was a few years ago, or has that not changed despite the political environment?
I think the selection of having a US investor or not have a lot to do with various different things. One is, what's your aspiration in terms of exit? I still think that despite what happened to DD, or there's still aspiration to getting listed on NASDAQ and the New York Stock Exchange. That's one consideration. And second is, like what is your focus in terms of market expansion on the long term? I think a lot of the Chinese company now seed round could be actually just purely RMB, and their whole path could basically stay in China and get listed in Shanghai. So in that sense, there's no need. But if you're the ByteDance of the world, where you do think that, when you get a little bit more mature, you actually want to go to the US market, that would make a lot of sense. Last but not least, it also depends on what vertical. I actually think that, and I said the same thing to US entrepreneur to come to China and vice versa. TikTok and ByteDance is definitely an exception to the rule. That is not a common case. If you're doing anything with sensitive data, doesn't matter, it's social, transportation, news, I think cross-border both sides is just super, super tough. But I do think there's a lot of really interesting, as I mentioned, sort of the Pernetics or the Data Cook of the world, both of them are actually getting listed, and the market is mainly in China and Asia. So there's light at the end of the tunnel.
Something optimistic on China. Great. Thank you, Edith. We're now going to turn to our third panelist, Nick Borst. Nick is Vice President and Director of China Research at Seafarer Capital Partners here in the Bay Area. He's also participating now in the National Committee on U.S.-China Relations Public Intellectuals Program. And in the past, he's worked at the Fed and at the Peterson Institute, where Nick Lardy is. So Nick Borst, over to you.
Great. Thank you, Andy. And thank you to the Asia Society for organizing this great event. I think the U.S.-China investment relationship should be a real source of strength between the two countries. It should be about the flow of capital and investment returns. It should be about improving transparency and corporate governance. And I think it's one of the few areas between the US and China where we can really get away from a lot of the zero-sum thinking, where China's economic development doesn't have to come at the expense of the US. And I think US investors should be able to feel a tangible benefit from China. Unfortunately, I think we're far away from that ideal state. And there's many aspects of the US-China investment relationship that I think are broken right now. And so just to list some of the major problems, we see a major effort to force Chinese companies to delist from US exchanges. We see ongoing disputes between Chinese and US regulators. We see an ever-growing list of different investment bans impacting US investors. And finally, just ongoing real uncertainty about the property rights of US investors and their investments in China. So I think there's many reasons why the investment relationship is currently in the sorry state that it is, but I want to focus in on a few that I think are most important. On the Chinese side, I think it comes down to two things. The first is I think China needs to make further progress with opening up its economy for foreign investment. As Nick mentioned and others have pointed out, China has made progress in opening its capital accounts. We've seen progress in some sectors, including automotive and financial sector, but over many important areas of the economy, I'm specifically talking about the technology sector here, there continue to be pretty strict foreign investment restrictions. And those have the effect of putting the investments by many US investors in Chinese companies under a cloud of legal uncertainty. And so I think it would be beneficial not only for China's economy, but for the investment relationship more broadly for China to continue to open up and resolve that uncertainty. The second major issue on the Chinese side is just this push, panelists have talked about it throughout the day, by the Chinese government to reassert control over many parts of the economy. And this has come through a variety of different forms. It's come through pressure on Chinese companies to establish CCP party committees within their corporate structures. It's this move we see with new data regulations that increasingly treat many forms of data, including many forms of corporate data, as a matter of national security. And it's just the sheer regulatory uncertainty we've seen over the past year and a half from China, where we see a near continuous stream of new regulations coming out for industries, often with little forenotice. They're often quite draconian in their effects, and we've seen a few industries in China basically wiped off the map as a result. So on those two areas, I think China has taken actions that have put stress on the bilateral investment relationship, and there's room to improve. But that's certainly not to say that the US is blameless in all of this. And I think there's really a need for us here to rethink some of our approaches. Starting with the Trump administration and continuing into the Biden administration, there's been an approach, basically an all of the above approach to economic and financial sanctions on Chinese companies, and efforts to use restrictions on Chinese companies as a way to achieve foreign policy goals. And while the US certainly has a right and responsibility to protect its national security interests, I think our approach over the past couple of years has been problematic for a couple of reasons. Number one, I think many of these restrictions are much less effective than their advocates would have us believe. Nick mentioned earlier in his remarks just how easy it has been for Chinese companies forced out of the US market to raise capital elsewhere. So many of these investment bans just don't have the impact that we think they should have. Second, I think these restrictions have created huge amounts of uncertainty for US investors and US companies trying to do business in China. And third, and I think this is ultimately the most important over the long term, is that the way that many of these restrictions have been rolled out reinforces narratives in China that the US is opposed to China's economic development and that we're not open to competition by Chinese companies. And I think those narratives are just so damaging to the long run health of US-China economic relations. So I think it's time for us to have sort of a rethink of our approach and make sure we're kind of meeting the highest standards in terms of transparency, accountability, and due process. So just to recap, I think the US-China investment relationship could be a real source of strength between the two countries, but right now it's anything but that. And it'll take big changes on both sides to put it back on the right track. But I think given the atmosphere between Beijing and Washington, I'm just not hopeful that we're going to see that anytime soon.
Well, maybe a little bit less upbeat, but I really agree with one of the points that you highlighted a moment ago, Nick. My experience from living in China for more than 20 years is that the vast majority of Chinese people, including the people that I worked with in the government and the Communist Party, had a pretty high opinion of the United States, didn't necessarily want to have China look exactly like the US, but admired a lot of elements of this. And I worry that, as you said, kind of casting a negative opinion about the rise of China, the kind of statements that we hear from our government, which to me at least sound like opposition to Chinese companies becoming globally competitive and successful is going to cause real long-term damage to the way that the average Chinese person thinks about the United States. So thank you for raising that. One quick question for you. You spend a lot of time looking at companies. I hear all the time people say, well, there can't really be any private companies in China the way we think about privately run companies because the government or the Communist Party is everywhere. How do you respond to that?
I think you just have to look at the actual operation of the company. I think take all the pre-notions you have about what a company is or isn't, throw it out the window, look at the actual operation of the company, meet the management, try to determine whether it's operating in a market-oriented way. And I would say, my experience looking at Chinese companies, ownership structure is not necessarily the most important factor for determining whether a company is market-oriented or not. So you'll meet Chinese SOEs that are actually, models of corporate governance, quite market-oriented, treat minority investors decently, and you'll meet, quote unquote, private companies who are the exact opposite, who seem to be very aligned with state goals and connected to the party and really operating in ways that don't make sense from a market perspective. So I think really it's tempting to assign labels and divide the world between SOEs and private companies, but I think it's really much more important to look at the individual company because every company is different and you won't really know how a company is run until you spend the time to research them and meet with the management.
Thanks, Nick. All right, we're now going to turn to our fourth panelist, Rui Ma. Rui has worked for 16 years in finance, mostly in the tech sector between the US and China. And she's now at Tech Buzz China, which is a community for investors focused on China tech as well as the VC community. Rui, good to have you with us. Please share your perspectives on the risks of financial decoupling.
Yeah, thanks. Sorry, my voice is shot. I'm just recovering from COVID here. So I have some overlapping points with Nick, the first Nick. And my main points I'll just summarize in the beginning, and then I'll go to why I believe this is the case, which is that, when I focus on tech, and in terms of tech investment and tech financial decoupling, there are two markets that maybe we care about. One is the private markets, venture capital, private equity, et cetera. And then there is the public markets. And if we look at private markets, I would say actually there's very limited things that the US can do in terms of, decoupling from China to hurt China. And then on the public markets, there is a little bit more room, but that is probably fading quite quickly as well. So I'll give some, and then I believe that both of these things, when, the US is putting in restrictions or pulling away from China actually hurts US investors and US businesses primarily in the long run. Let me explain what that means. So on the private market side, on in venture investing, especially, China actually has a very different ecosystem from the US. It's really shifted in the last 5 years to be a lot less consumer internet and a lot more enterprise software, healthcare, and advanced manufacturing. In fact, since 2014, that's almost 8 years ago, the top categories, the top three categories are the three I just said: healthcare, advanced manufacturing, and enterprise software, in that order. And last year, just healthcare and advanced manufacturing alone accounted for 40% of the dollars invested into early stage, which I'm defining as C to Series B. And if we include motor vehicles, which has a lot of electric vehicles in it, and local services, which is probably the only internet-heavy business in here, so local services are like delivery, etc. Those five sectors together already account for 75% of dollars deployed. So, and in fact, China almost looks kind of opposite of the US in some ways. The fintech, for example, in the US was one of the largest sectors last year, raised $39 billion in VC. But in China, fintech has consistently been one of the lowest, sectors, in the smallest sectors in China, and last year it was less than 2%. So what this basically means is that the Chinese funding environment actually looks different. So when we think of VC, it's no longer the case that USD denominated venture capital is dominating the market. In fact, in 2018, about RMB denominated VC and PE into tech was more than 30%, was 30% higher than that of USD. And in 2019, they were about equal. Now, it is still true that the USD denominated funds tend to dwarf RMB funds in size. And that's primarily because the US has a much more mature LP, limited partner, so people who are deploying money into these funds has a much more robust ecosystem there, with much larger endowments, pension funds, long-term investors. In the US, these long-term LPs make about 50% of the LP base. In China right now, that's just 5% actually. And you can compare, like, for example, Harvard's endowment is 53 billion. Tsinghua's endowment is 1.4 billion. So there's still a big staggering there. But what we're seeing is that China has a lot of government funding that is making up the difference. So to give you some stats, last year of the top 100 fundraising events in China, this is just by dollar amount, 30% of them were in the manufacturing sector. And then also, not the same 30%, but also 30% of these funds had state funding participating. And state funding is participating in almost half of the new funds raised in the last 2 years. And you might think that, state funding, when I was raising money in China 8-9 years ago, the state funding LPs are not very sophisticated. A lot of them have a lot of requirements around, investing in the local ecosystem. So this is maybe not so much market-oriented money. And while that is still kind of the case, but when you consider the sectors that are being the money is being deployed into, you might actually find that state funding in China is helpful for a lot of the deals being done today. Because, for example, in manufacturing, it's a lot more helpful to have local governments help you with, infrastructure, give you subsidies, and then help with land, for example. So state funding actually may turn out to be more a better source of capital. We'll see. This is a change that's really happened in the last, let's call it 2 to 3 years, been really visible. But overall, we can basically see that RMB funds have been investing in the dominant sectors, manufacturing, enterprise, et cetera, in the last 5 years, much, much more so than USD funds. USD funds have been primarily investing in, consumer internet. The only thing I would say USD funds have done well in is healthcare, and for a lot of these. For when you consider the entire capital outlay, basically there's not really an need for USD as much as we think there is. It's still a significant portion, but it's now a minority of funds being deployed. On the capital market side, basically there is still an advantage to US capital markets. I also had some data on the STAR market. So if you look at 2021, the Chinese companies raised $40 billion on Hong Kong and American exchanges last year, but they raised actually $30 billion on just the Shanghai Stock Exchange last year, the STAR market. So domestic markets are not, nearly enough to meet the total demand for funding, but they're not nothing, right? And they're growing quickly. As Nick said, there is actually quite a bit of capital in China. It's more that the exchanges themselves need to be reformed, and the listing process needs to be more friendly towards companies, so that even smaller companies in China can get liquidity. We already see that large companies, especially tech companies, which I'm most familiar with, when they go to Hong Kong, really no problem in terms of liquidity. But we do see that with companies that are, less than, let's call it $3 billion in valuation, they're having a lot of trouble attracting investor eyeballs. And that's just because the Hong Kong Stock Exchange has an average turnover of like 20 billion, and the US has an average turnover of 400 billion. So there's still some catch up to do there, but there's a good amount of capital. So overall, what I would say is, the especially in terms of tech, I think the Chinese capital markets on the private side is more than sufficient to sort of pick up the slack, and has been doing so for the last 5 years. On the public market side, some of these restrictions that we're putting forth is working and is quite, harmful to the companies, but I'm not sure how long that will last, because as we can see, there's a trend that the Chinese capital markets will be catching up as well.
Thanks, Ray. So I want to follow up on one of the last points you made. Do you think that the sanctions, as well as the political rhetoric in Washington, is having a negative impact on the technological side as opposed to the funding side with Chinese companies that you work with? Are these sanctions succeeding in slowing innovation in China, which is a statement that the Commerce Secretary made several months ago, that was her aim?
Yeah, so I would say no, because actually, let's pick one specific sector, which a lot of people talk about, which is the semiconductor sector. In fact, what we've seen is that the semiconductor sector, the sanctions have created market opportunities for domestic companies where none existed before, because previously, if you had access to an entire global market, most market-oriented companies are going to pick the best technologies, which means primarily foreign technologies and foreign manufacturers. But now that they are scared of being locked out, then they are investing in either parallel, or sometimes if you're like a Huawei, for example, where you're entirely cut off, then you have to invest in entirely domestic supply chains. So these sanctions have actually sort of forced a market. So the semiconductor space in particular has experienced a boom, and it has a lot of people confuse that with the regulations and the so-called crackdown on the internet space. But that's very misleading, because again, when you go back and actually look at when that space started exploding, it is very much due to U.S. sanctions. So I would say in deep tech, that's certainly not the case. I know that there are certain bills being contemplated right now, also around biotech. On the U.S. side, it doesn't seem as restrictive. It seems to be more about research, but I think that's also probably not going to work out too well. It'll probably just create more capital being funneled into these markets now, when people realize an entirely domestic supply chain or research base or IP is just as viable.
Thanks, Ray. So first, for our audience, please continue to submit questions for our panel on the Q&A box on the bottom of your screen. Thank you for those that have been submitted, and I'm going to fold a lot of those questions into the conversation that we're going to hold for the last half hour of this session. And I want to go back to, or I think a theme has emerged from here, which is that maybe our government is overstating the leverage that it might have with the Chinese economy and understating the damage that might happen to our own economy in terms of having a more aggressive and confrontational approach, a sanctions-based approach towards China. In the previous panel, we talked about, one of the panelists talked about how important it is to the US semiconductor industry to sell chips in China to make enough money to funnel back into R&D to maintain a global lead. So I'd like to start this part of the conversation, maybe going back to Nick Lardy, because you mentioned how I think maybe ill-informed some members of our government are. Why do you think that's the case? You're the one panelist in Washington, so hopefully you've got a better insight in this than the rest of us have who are further away. Is this just ideological blinders to understanding the reality of the economic and financial relationship? And is there any hope of straightening this out and moving to a more constructive approach?
Well, Andy, I think you put your finger on a main problem, and that is ideology. And quite frankly, the problem here is in large part on the Chinese side. Under Xi Jinping, we've seen the role of the Chinese Communist Party being strengthened roughly in every dimension of Chinese society, economy, the military, and so forth. So increasingly, China is perceived as a communist-run country with an ideology that is contrary to US values. And I think pre-Xi Jinping, everybody knew it was a communist country, but that was not the predominant perception that they were reforming and opening up, and it wasn't. So that perception has changed dramatically, and as I say, I think that can be largely attributed to Xi Jinping. So that's number one. I think number two is that U.S. businesses have not had much of a voice in this administration. They, given the fact that you have a kind of united front between Republicans and Democrats, vying with each other to see who can introduce the most legislation that's anti-China, it's much more difficult these days for businesses to try to make a rational case, for a more nuanced approach. So two things: the ideology that has become much more dominant in China, and the reluctance of U.S. companies to try to advocate for a more nuanced policy, given the kind of united front between Republicans and Democrats.
Up until recently, really my last trip to Washington in November, I had hoped that maybe after the midterm elections in the fall, we might see a shift to a more constructive approach towards China. But now I'm feeling like it's not likely to happen. Can you cheer me up on this, or are you as pessimistic as I am?
I don't think I can cheer you up. I'm at least as pessimistic as you are. I think views are hardening, and I don't see any outcome of the midterms that is going to significantly change the equation.
All right, Edith, can we draw you into this conversation? How do you see views among the people that you're talking to in China and Hong Kong? Is there still kind of an open mind towards the financial relationship being beneficial to both sides, and they kind of want to wait out these political problems, or are positions hardening, as Nick said, in Washington, from what you're seeing in China?
I think it really depends on which industry that we're focusing on. Lately, I've been actually quite active in the Web3 crypto space. It's definitely not looking good at all. In 2017, 2018, China was the center of the universe, especially with Bitcoin mining and also crypto exchanges. Now, hash rate basically dropped to almost zero because of the crackdown last year for mining, with good reason, because of energy use. And then with education, basically the whole industry disappear overnight. If you are working in New Oriental or Tao, literally their stock price dropped 90 to 95% within a couple of weeks. So if you're in that area, definitely not that great either. And then in another example, I think we've been seeing Tencent selling off ownership of a lot of the investment they've been doing. And yeah, so unfortunately, it's not doing that great. And a lot of my friends, including my cousins and family in China, their viewpoint is they understand sometimes why government are taking a little bit heavy-handed iron fist on certain policy. But consistently, they think that many of these policy, the way that it's being implemented in such a short period of time, where it's actually quite difficult for many of them to adjust. But at the end of the day, there's another thing that is also going on is, in the past, including my cousins, he would tell me that, one day I probably want to come to the US and maybe set up another shop. But at the same time, there's another layer of media within China that also painting a picture that America just don't welcome Chinese, doesn't welcome any Chinese. And in fact, they even ask me sometimes, why am I staying in the US? Whatever that they see, what's going on in all the violence that is going on, particularly in San Francisco. So I think many of the Chinese entrepreneurs, depends on what you're working on. In the Web3 space, many of them actually have migrated to Singapore. Singapore been a hot spot for some of them. But again, it really depends on what industry that you're in. As Ray mentioned, with great statistics, if you're in supply chain, healthcare, semiconductor, China is the place to be. But if you have international aspiration on go-to-market and US growth, many of them don't even bother to come because the quarantine criteria to come back is 2 or 3 weeks. Like, who can do that? So I literally have not seen any of my family and friends or colleague for almost 3 years now. This is on the 3rd year. So it's just really, really tough time.
Thanks. We've had a number of people in the audience ask questions about the IPO pipeline from China into the United States and the possibility of delisting of Chinese companies that are already listed in our markets here. So maybe let me just give a brief summary of what that issue is about, and then I want to get some of the panelists to comment on this. Basically, when Sarbanes-Oxley was passed in the follow-up from Enron, it called for the creation of the Public Companies Accounting Oversight Board, the PCAOB, and the law requires the PCAOB to audit the workbooks of the accounting companies that do the support for companies listed in the New York Stock Exchanges, including NASDAQ, regardless of what country they come from. The US has negotiated agreements with a number of countries to make this work, but one place they haven't been able to get agreement so far with is with China. Those negotiations are apparently ongoing. Although I have to say it's a bit distressing to me that I'm able to get a lot more information about the negotiations from the Chinese regulators than I am from our own regulators here in Washington. But aside from that, some people are asking the question, why not just kick Chinese companies out of the United States? Wouldn't that be better for American investors? So Nick Borst, how do you feel about this? If Alibaba and other Chinese companies that are listed in the New York Stock Exchange, NASDAQ, are kicked out, relist in Hong Kong or Shanghai, will you continue to invest in those companies? And will this make it easier or harder for you to do the kind of due diligence you want to do for your clients?
Thanks, Andy. Well, I'm not going to say what we'll do specifically so I don't get in trouble with our compliance officer, but
for sure.
Just in general, this goes back to the item I mentioned earlier about how ineffective some of these efforts are on our side. So we restrict investment on specific Chinese companies via executive order, or we force them out via these audit disputes. And for a lot of companies, it really does not have that much of an impact, as you've seen many Chinese companies pursue secondary listings in Hong Kong in anticipation of this. Now, that doesn't mean that it'll be perfectly smooth for everyone. There may be some retail investors that aren't able to switch over their shareholdings to Hong Kong, but I think ultimately much less disruptive than piggybacking on Nick's comments, what some regulators here would like to believe. But just to circle back to the larger audit issue, I think you did a great job explaining it, and it's one that's been going on between the two countries, I think, for more than a decade now. And it's kind of one of those issues where both sides are at fault. The US has a right to hold all companies, foreign or domestic, to the same audit standards. And we can't have carve-outs and exceptions for Chinese companies. And so it's very legitimate to say, hey, we need access to all your audit work papers. And this ties back to the efforts in China recently, I think, to treat many types of corporate data as a matter of national security. And I don't think for a publicly listed company, audit work papers should be treated as a matter of national security. However, I do think there's some compromise to be had here. And as you mentioned, the Chinese have said multiple times, we want to find a way to work this out with you. I think they've even done some joint, co-audits together. And so I think there is a way where we can satisfy what US regulators want while preserving what China views as a matter of national sovereignty. But I just don't think the appetite is there. And maybe there's a little more appetite on the Chinese side, as you mentioned, but at least in terms of the US at this moment, there seems to be very little willingness to constructively solve this issue.
Yeah, I worry about this too. And I worry about the domestic political issues in the United States overriding what's in our country's best interest, which in my view is if we're going to continue to have the predominant capital markets in the world, we need to have Chinese participation. But I worry that the atmosphere in Washington is not conducive to an agreement with the Chinese government that requires some compromise on process, but gets us to the objectives that are laid out in Sarbanes-Oxley.
Yeah, I would, having the world's largest, most interconnected and most important capital markets is a source of US strength. And I wish US regulators would see it as such and take steps to preserve it.
Yeah. So I'm getting the impression, and I'm going to put words in your mouth here, panelists, that you all agree that the US has limited leverage to force China to do what we want them to do in the financial markets, but that we might also be the biggest loser if there is real decoupling in the financial system. Do you all agree, or just tell me where you agree or disagree with that?
I basically agree. I think we overestimate our leverage on China in several domains, and the financial sector is just one of them.
Right?
Yeah. I was going to say, I probably agree in the short term, again, that there some damage can do on the capital public side, but the long-term implications, as Nick Borst was saying, it's not good, right? So when we make our capital markets, less open, less free, more restrictive, and more, to some people, seems more arbitrary, then we're losing our source of strength, because that is one of the places where the U.S. absolutely dominates, and China has been trying to build up its own domestic markets for a long time, and this is sort of playing right into the Chinese government's wishes by accelerating it.
Mm-hmm. Okay, Edith and Nick Borst, do you want to jump in on that?
I want to point out that Jamie Dimon took a less than 2 days trip with no quarantine in November to visit Hong Kong to make sure that his team in Greater China is still feeling the support from headquarters. And there's a really big disconnect between the media and the regulator and what the investor is actually doing. And then on top of that, last year, within the mainland market, in terms of international investment, is like 15% is come from international. In fact, I have friends, and by the way, worldwide investor is not only the US, in Europe and also in the Middle East. The investor in those regions are very, very bullish in China. And the sophisticated investor in the US is finding ways to participate in the Chinese stock market, either the US regulator like it or not. So I very support what Nick Borst was saying. We need to be very concerned and make sure that we still have the strongest financial market and exchanges in the world. And we need to have Chinese companies listed in the US.
I asked the Hong Kong government if I could get a Jamie Dimon visa and to go visit, and they said they had a room for me at Penny's Bay.
And just to close the loop on this, I agree with what everyone else said. I think ultimately at the end of the day, the US and China both have big enough capital markets that if we force them apart, both countries will continue to develop economically, but we'll be poorer as a result of that. And as I mentioned before, it's really one of the only areas where we can see sort of a positive non-zero sum thinking in the relationship. And, with there's so many intractable problems on the political side and security side, it's really only in the economic relationship and the investment relationship where, it doesn't have to, one side's benefit doesn't have to be at the expense of the other, but there's really not an acknowledgement of that. And I think we're taking short-term steps that really weaken that long-term source of stability.
Well said, thank you. We've got about 10 minutes left, and a few people in the audience have asked questions that are more about the Chinese economy than about the topic of decoupling and the impact of that. And so since I got the platform here, I'm going to switch tack a little bit, because I think we have a fantastic group of people here who've been following China for a long time from different perspectives. So I'd like to get at kind of the core of the questions that I've gotten from several people in the audience. What is the role and the status of the entrepreneur in China today? Not only do you have difficulties with the US with sanctions and harsh political rhetoric, but more importantly, in China, we seem to have more control from the government. We have a philosophy of common prosperity and trying to figure out what that means. I'd love to get the thoughts of each of you in terms of where is the private sector and the entrepreneur in China today? Is it as important for driving growth and innovation and job creation and wealth in China now as it's been in the last decade, or is that fading? Who wants to go first?
Let me take a shot at that, Andy. First of all, we have to begin by recognizing that the data we have to evaluate some of these issues is not always as complete and detailed as we would like. But I would just make a couple of points. The Chinese recently released a list of the 500 largest private companies. And all we read about in the West is the crackdown on the internet platforms. Well, the internet platforms account for 11 of the largest 500 companies in China. And I think they account for something like 7% of the revenue. So most of the big private companies are companies that you and I, or at least I'll speak for myself, I've never heard of. And they haven't been affected. You know, we read about people are wringing their hands about what's happening to Didi and a few other companies, but I don't think it has had much effect on the vast majority of private companies, whether they're in services or in manufacturing. The second thing I would say is that we do get monthly data on investment by private companies, or what they call people-run companies. And the share of investment by these companies has not diminished at all over the last year and a half. So there's been this crackdown, very public. You know, Jack Ma and the rest of them have lost $1 trillion in their stock portfolios. But the thousands and thousands, and I would say, remind people, there are 20 million private companies in China. The vast majority of them seem to be investing and expanding their businesses. So I disagree completely with what Kevin Rudd said in his opening remarks about how entrepreneurs are under pressure and they're disinvesting and the Chinese economy is going to the dogs. Private investment, at least as best we can see from the data, is still holding up quite well. Now, maybe next quarter or next year, it will collapse. And if it does, it'll be a very bad sign. But I think there's a tendency, particularly in the press, to extrapolate from what happened to the big headline platform companies and assume that that's representative of the overall economy. And I would caution against that kind of an extrapolation.
Yeah, thanks, Nick. Ray, Edith, Nick was kind of focusing on data here. What anecdotally can you tell us that you're hearing from your business contacts and friends in China who are entrepreneurs?
I can go first. Well, I was going to give some data as well, but basically, I think in the last couple of days, this is something I think it's very well known in China, but the press just picked up on it, which is that, you know, I think the headline is, despite tech crackdown, China venture capital is at an all-time high. So Preqin, which isn't the source I'd use, but even Preqin, which is a US-based source, said, you know, is an all-time high, was $130 billion last year. Still just half of the US. But again, if you look at the source I was using, which is ITG, a Chinese source, you can definitely see that for early stage, which is where I think we should focus on if we're talking about entrepreneurial activity. So again, seed up to Series B, last year was about $75 billion, and it was like the highest of the last, you know, decade. So I think that again, the disconnect I think is because when people will talk about tech, they're really thinking of internet platforms in the US, but in China that is, as Nick was saying, it's not a very large percentage of the economy. And while it is, you know, disproportionately represented in the American capital markets, it is on a you know, market cap level, we're even seeing some displacement, right? The fourth largest Chinese company by market cap now is a battery company, right? That's a company that called Cattle that I find very few people talking about, but they actually they supply Tesla with batteries, and that's definitely tech, and that's a sector that's been, you know, blowing up in China. So anyways, no decrease at all in entrepreneurial activity. In fact, I would say it's an all-time high. It's just not in sectors that that people are familiar with, and therefore maybe are not categorizing as tech. But when you slow down and think about it, is absolutely should be counted.
Okay, thanks, Edith. Or just briefly, are you seeing the same kind of thing?
Yeah. So really, not necessarily statistics, but more or less. I remember when I was working on Dolphin Browser, which is more, it was based out of Beijing and Wuhan, and our team, 300-400 people. Most of the government relations is dealt with by the CEO. Like, you need to go and participate in various different activities to support the local governments on economic growth. And nowadays, I feel like it doesn't matter you're B2C or B2B. having a government relations person in your startup or your tech company is a must. In fact, what I started to see is some of my old friends who used to be in state government based out of San Francisco, when they go back, they will become like a VP level or GM level for, let's say, the Lenovo or the SenseTime of the world. And their full-time job is to work with government, not just from a regulatory point of view. In fact, selling to government, to G, how they say it, is part of life and is the biggest enterprise that they would sell to. So this is definitely something I felt is very, very different from the US, but it's just part of life as a tech entrepreneur in China or in Hong Kong soon.
Great, thanks, Edith. So we're quickly running out of time, unfortunately, because we could go on, at least I could, for a long time with this group. But I want to address two other questions that have come in from the audience. One I'm going to answer very briefly, and the question is, should American investors be okay with the fact that Chinese companies listed in the United States are disclosing less and less transparent than American companies here? And I just want to maybe clarify what I was talking about before. Chinese companies listed in the United States are already responsible for complying with all SEC regulations, and the SEC has the power to enforce those regulations. What we're talking about now with the audit issue is a government-to-government agreement to allow the Public Company Accounting Oversight Board to audit the workbooks of accounting companies. The second question, and maybe I'll throw this to Nick Borst as we get ready to wrap up, is should American government retaliate against Chinese companies in the same way that the Chinese government restricts the activity of some Chinese companies, particularly in the online space? So for example, if Google can't do business in China online, should we stop TikTok from doing business here? Is that a way to make progress? Is that a bigger stick? What do you think, Nick?
I don't think so. I think that's a recipe for a race to the bottom. Just to go back to my earlier comments, I think we're at our best when we have free, fair, and open markets, and that we set the rules for everyone to compete. It doesn't matter where a company is from, as long as you come to our markets and follow the same rules, you're allowed to compete fairly. And so I think we should certainly, target unfair practices by Chinese companies. I think we should push for more opening in the Chinese economy itself, but I see very little to be gained by closing ourselves off from Chinese competition. And I think we'll ultimately make our economy less competitive as a result.
Okay, thanks. So we're really winding down now. So I want to go back to Nick Lardy, who's been working on these issues longer than the rest of us have, and who's also sitting in Washington. It's kind of depressing to me that, some of you may know I worked in the State Department for a long time before I got into the financial services industry. But I never went back to Washington for a long time because it was just not all that relevant to writing about the Chinese economy. Now I have to go there all the time. So Nick, help me out here. When do you think, what can we do as Americans or people living in the United States who want to see a more constructive, collaborative relationship, particularly on the financial side? What can we do to try and push things back in the other direction that will resonate in Washington?
Well, I think in the short run, there's probably not much we can do. I think in the medium term, it's supporting organizations like the Asia Society or National Committee on U.S.-China Relations, organizations that are invested in trying to have a cooperative, mutually beneficial relationship with China. So it involves a lot of public education like those organizations do. So I don't think there's a quick silver bullet. I think it's going to take a long-term, more sustained effort than we've seen. And there's some basis for thinking that might work. When you look at the opinion polls in a lot of locations outside of the Beltway, attitudes towards China are more favorable than they are certainly in Washington and very certainly compared to the Congress. So if we can build on that, I think there's a possibility over the medium term of improving things. I don't see any silver bullets for the short run.
I think those are wise words. I wish it was an easier story, but what you say, Nick, makes a lot of sense. And I would also encourage everybody in the audience to follow Nick's suggestion and become a member of the Asia Society and the National Committee on U.S.-China Relations as well, both groups putting out great educational work like the conference that you're listening to today. So with that, I want to wrap up and thank Nick Lardy and Rui Ma and Edith Yeung and Nick Borst, and turn it back over to Margaret.
Our thanks to Andy and Nick, Ray and Edith. We appreciate the support and we appreciate you sharing just a little bit of optimism with us today. Ray, we also hope you fully recover soon. A big thank you again to our conference sponsors. Many have been with us for multiple years: Magdalene Yum, Kenson Ventures, Tencent, Greenberg Traurig, NEA, and more. This afternoon, starting at 1 p.m., we have sessions on semiconductors, business, and Xi Jinping. We'll now have a lunch break for 1 hour. We'll see you back here on this same Zoom link at 1 p.m. Pacific.